Welcome back to the Commercial Real Estate Investor Podcast. Today we are here with a good buddy of mine, Chad Griffiths. Chad and I have actually known each other for a few years, reached out on Instagram. That's actually how we got connected. He was writing an article for Forbes, actually. So we're gonna have to talk about that a little bit. That's pretty cool. So Chad and I got connected, obviously, because he was one of the more forward-thinking brokers. We were both on Instagram really before anybody else was. He's been doing industrial real estate up in Canada for 15 years and is not only a broker, but he's also an investor. So he's got a wealth of knowledge when it comes to industrial real estate, which is obviously a hot topic and has been probably for the past 5 years, just because of the growth of e-commerce and how everything is shifting to this online kind of area where you've got to have a whole lot of logistics and distribution facilities to facilitate that. So, Chad, brief introduction, man, but tell us a little bit about yourself and how you got into real estate.
Well, thanks so much for having me on, Tyler. As you mentioned, I've been a fan of yours before we even met, so it's an honor of mine to continue our friendship going on and to be on your show. So thanks again for the introduction on that. So I started in real estate in 2004. I actually did residential for the first year and quickly realized that just wasn't for me. So I sought out a commercial real estate brokerage to join, and as luck would have it, it turned out that office that I joined was predominantly involved in industrial real estate. So it was almost by accident that I got into industrial real estate. That was about 15 years ago now, and I'm sure glad that I did because I've spent my entire career at the same brokerage that I've been at since 2005 now. And along the way, I've become a partner in my firm, and then I've also started investing in property. So I bought my first industrial property in 2000 and end of 2014. So roughly 2015, and then I've slowly just added to that as well. So with a handful of partners, we're up to about $12 million in assets under management. So I love talking about industrial real estate, so I'm excited to chat with you more about it on this call.
Yeah, that's awesome, man. One thing that I didn't mention is, because Chad is forward thinking, he's also got a YouTube channel where he is teaching you guys how to invest in industrial real estate and everything you need to know about industrial real estate. So definitely check out his YouTube channel. Chad, is it under your name? Is it just Chad Griffiths?
Yeah, I put up. It gives you that long-winded email
Yeah,
or ending at the end of YouTube. So I did set one up. It's Chad Griffiths CRE is
perfect.
the one on it. Interestingly, about that is there's very few people talking about industrial real estate on YouTube, which is one of the
Like
reasons
no
that I
one.
like nobody. So if you just search industrial real estate, there's a good chance that one of my videos will show up because I'm really the only person talking about it.
Yeah, that's awesome, man. That's such a great niche too, because I mean, dude, people are curious about industrial real estate, and there's no content out there. I mean, that's why I started creating content on commercial real estate, right? Like, there's almost nothing out there. There's only like if you take the whole industry as a whole, there's really only a handful of us that are doing anything like that. So, interesting. I didn't know that you started off in residential real estate. Tell us a little bit about that experience.
Well, I guess I'd go back even a few years before that. So I was working at a restaurant part time, and I was going to business school. And after my first year of business school, the restaurant offered me a management position. And I was young, I was dumb, I wasn't really thinking long term on it. So I actually dropped out of college, took the job as a manager, and I hated it. There's elements that I liked about working in the restaurant, but I hated managing a bunch of teenagers. So I did that for about a year, and then kind of just messed around. I ended up bartending for a couple of years, and in that time, I started buying and selling houses with a few friends, and really got a taste for real estate at that time, just on the long term potential for it, on how you could really build wealth in that. So I wanted to see how I could explore that as a potential career, so I didn't have to be a bartender when I was 50, trying to think long term out on this. And real estate was just the natural extension. So got my license. All I knew at the time was residential from buying and selling a few houses. So I slid into residential real estate. I did that for a year and actually did reasonably well at it. I hustled. I worked as hard as I could. That was in 2004, and there wasn't a lot of technology at the time. So I set up a website with a pretty good URL that was memorable, and really tried getting that online traction. So I actually did like reasonably well for that year in residential. but just really didn't like it. So it's similar to like being a manager at a restaurant. I just couldn't see myself doing that long term. So I asked my uncle, who was a prominent architect in the city at the time, if he could help me transition into commercial. And he set up a couple of interviews. One of them, so I had two interviews on one day. The first interview that I had went so well that I ended up missing the second meeting, and I took a job at that commercial brokerage that
Wow, that's
morning.
awesome.
And I've been at that same brokerage ever since.
Man, that's a great story. I started off in commercial real estate. Most people are not that lucky. They actually start off in residential and transition into commercial. And it's funny how different of a personality type that side of real estate requires, right? I mean, it's a totally different sale. I mean, in commercial, industrial, you're dealing with a very logical, straightforward, either the numbers work and the location works or it doesn't. There's almost little to no emotion involved in it, and I'm just not a good emotional seller. I'm like, hey, the numbers work, let's get it going. So that makes complete sense as to why you would transition out of it too. Tell us a little bit about industrial. I mean, when you moved over to this brokerage, how and why industrial?
Oh, great question. So I had this big dream that I'd be selling office towers. When I thought of commercial real estate at the
Yeah,
time,
don't
that's
we
what
all,
came to
right?
mind. Yeah, we all just think about being on the top floor of an office tower downtown, and that's what I legitimately thought I'd be working at. But the brokerage that I went into was predominantly into industrial. So almost just pure accident, I stumbled into industrial, but I recognized very early on that it had huge potential because it's a very steady, stable, boring business, and boring by the standpoint that it doesn't have the same big ups and downs. And there's nothing to personify that more than what we just went through this past year, where people were working from home and some retail stores were closed down. Like that was a huge roller coaster for the office and retail markets, whereas industrial did pretty steady. So I looked at industrial as something that I could really build out and have some longevity with, get to know it really well, and become an expert in it. And part of the reason that I started a YouTube channel was because there was very little available. That was 2005 that I joined that brokerage, and I wanted to learn as much as I could about industrial, but there is surprisingly little available. And fast forward to today, and it's still a problem. I think industrial real estate is fascinating. If you actually look at it as a core, there is a study done a year ago or so that indicated there's about 20 billion square feet worth of industrial real estate in North America. That's with a B, 20 billion. And the aggregate value of all
Wow.
that industrial real estate's over 1.5 trillion. So it's a massive industry. It's a massive contributor to GDP and just local, state, a countrywide GDP. It is a huge driver of the economy. So I'm fascinated by it, but I'm also just surprised at how little is available for people that want to get into it, like I did 15 years ago, or people that just want to learn more about it, whether they're a company that wants to lease space, or they have something coming up, or it's an investor. It's just surprisingly how little information is available. So it's been a labor of love of mine over the last 15 years, studying it, getting to know it as well as I could, so that I was not just an advisor to my clients, but then I could invest in it myself.
I mean, that makes sense, right? Because industrial real estate has, for the longest time, been seen as the least sexy side of commercial real estate, right? Like, most industrial brokers don't wear suits. They're wearing, jeans, boots, collared shirts, because you're walking through these dirty industrial properties with your clients, and they're not the flashy buildings that are going to be downtown with a giant sign on it, right? But industrial is, I mean, it's one of the sleeper, it's a sleeper. I mean, you've got cap rates that are rivaling multifamily in some respects. So will you kind of dive into what industrial properties are and kind of just give us an overview of the types of projects you're working on a daily basis?
Yeah, and to talk to your point, there's industrial guys often get the nickname of being dirty booters or dirty shoes,
Yeah.
just
Yep.
because we're walking through construction sites, or just dirty buildings all the time. So that's a very good point on that, and I joke about that sometimes too. Right now, I'm wearing jeans. I'm kind of business on top, and I work on the bottom.
Yeah, same here,
I've
man.
always
I'm always wearing jeans. I'm in sneakers right now. It's funny, like the office guys, they're always dressed to the nines. They're wearing the nicest suits. But yeah, not me.
Yeah, I haven't worn a tie in a while now. It's pretty rare for that. But so on the industrial side, I typically tell people that the most important thing to do at the beginning is to recognize that there are subcategories of industrial and they're fundamentally different from one another. So quite often when you hear industrial real estate, whether it's in the news or a broker just putting out a market report indicating what the vacancies are, they'll just group everything industrial under that one category, but there's some subcategories that are completely different from one another. So the first thing that I suggest is break down industrial into three main categories. The first is manufacturing properties. Second is warehousing or distribution centers, and then the third is flex properties. There could also be some additional smaller kind of tertiary categories like self-storage or miscellaneous ones like that, but the three main ones are that manufacturing, warehousing, and flex. So to break it down, and you'll see why they're so different once we explain a little bit more. So manufacturing is pretty straightforward. It's a property that's designed for things to be manufactured, assembled, produced. If you could think of like a big factory, that's what comes to mind for a lot of people when they think of industrial. It's just like a big factory where things are made, and that's the manufacturing side. The next biggest category would be warehousing, and that's the one that's becoming a lot more prominent in today's news as we hear about fulfillment centers like the big e-commerce giants. I'm sure Nashville's similar to my market. You probably had Amazon popping up all over. Amazon's got a couple million square feet in our market, whereas 5 years ago they had zero. That's all warehousing distribution centers. And the closest comparison that I could give for one of those, if you haven't been in one of those centers, is actually just going to a Costco or a Home Depot. Those are really big warehouses as well. They're just in a retail location, but it's the same principle. It's 24, 28-foot ceilings. There's racking all the way up it. There's loading doors for stuff to come in and stuff to go out. It's the same principle with a lot of these warehousing buildings. They just don't have that retail location. And then the third category is flex properties. And that's kind of a catch-all for all the properties that don't neatly fit into one of those two categories. Or it could even just be a property that's conducive for both types of uses. We are seeing some buildings being built now that could accommodate various types of uses, or it could just mean a property that is perhaps a showroom space. If you picture like a big car dealership that might be located in an industrial area, but it has a big showroom in it, that'd be a flex building.
Yeah, I mean, a lot of people don't think about, Costco, Target, Walmart, Home Depot. These groups they're all in warehouses. I mean, if you actually check out the building when you're walking through it, you're usually just head down, going to whatever aisle you're looking for. But if you look up, I mean, you can see the rafters, right? Like is it an industrial building? You've got typically just a vinyl over concrete type of floor. They've got loading docks. I mean, it's just a well lit, air conditioned warehouse is all it is. So we are live with Chad Griffiths. If you have any questions about industrial real estate, he started off as a broker. He's moved into investments years ago, back in 2014, 2015. Feel free to let us know in the live chat. We'll get around to those as well. So, Chad, talk to us about the transition from a commercial real estate broker to an investor. What was that process like?
I would say it was a very natural progression. And I think for anybody that is a broker or involved in commercial real estate in any capacity, whether it's a lawyer or an appraiser, banker, I think it's a natural progression actually. And I think that should almost be a goal of any professional, is to get into investing, because we have access to information that isn't readily available in the public. So we've got this deep knowledge of the industry. We've got a deep knowledge of what demand is for any particular property, and with some reasonable confidence, you can extrapolate out into the future to see what that property is going to be like 10, 15 years down the road. So for me, it was always a goal. I always wanted to be an investor in commercial real estate. It took a while before I had the financial resources and the comfort to go and do it. The first property that I bought was with my business partner. We bought it ourselves. We didn't have outside capital. We put our own money into it, and that just took some time before we had the money to do it. But I think that really should be a goal, providing there's not a conflict with any of the clients, providing there's not a conflict with the company that you work for. If you can do that without creating any tension or any issues there, I think that should be a goal of any professional to invest in something that you deeply understand. Oh, I don't have your audio there, Tyler.
Good catch.
Yeah.
So the I muted myself so that I didn't make any noises while you were talking. But the first building that I ever bought was an office building that a client of mine had under contract, and they were trying to buy it and couldn't get their financing together. And I eventually just said, I had assigned it to another client, and then he also couldn't get his financing together. So I said, you know what, let's buy it. But yeah, I think that's very important. You want to make sure that you're not conflicting yourself out when you're working with clients as a broker, right? Because we work with a number of investors, and I do value add investments. So I'm very clear with my clients on the front end that we're not going to compete with them on any deals. Um, the biggest thing for them to know is like, look, you can't take on everything. So yeah, I may get this deal over here, but that doesn't mean that I'm going to take every single deal that comes across my desk. It's not physically possible, which is it's a good and bad thing, right? You want to give your clients some good deals too. So I think that's very important. Chad, we've got a couple of questions coming in from the audience here. This is from Evan. How would you, a 23-year-old, get financing for an industrial building? Next year, I'll have about 2 years of tax returns, making over $100,000 a year. Could you get a 30-year loan? Could you get a 15-year loan? How does that look?
Yeah, that's a good question. The longest loan that I've ever got was amortized over 25 years, but it was a 5-year term on it. Uh, that's a great question. If you did want to lock in for 15 years, money's never been cheaper than it is right now. So if you felt confident that you were going to hold the property for that entire term, then I think locking in right now is a great time to do it. I'm always nervous of a term that long on what your penalty is to break it if you ever do have to get out of that property. Maybe you can port it. Maybe there's options that you have to buy it out if you want. I've personally just always been a guy that's confident and comfortable with a 3 to 5 year term. I've even done 1 year terms on mortgages. So that's the second part to the question. There is 15 to 30 year. If you're confident that you can hold a property that long, and if you don't, you've got some means to pay out that mortgage without a big penalty, then by all means, this is probably the lowest we'll see interest rates. Although I've been saying that for 10 years now, so
Yeah,
maybe
right.
we're in a low interest rate environment for the foreseeable future. But to your first point there, I'm a big believer in the first property that you get is to have skin in the game yourself. I know that there's guys out there who have done it with just raising complete outside capital, and they just came along in a management position where they oversaw the asset and did all the day-to-day management. I think the best way to prove to investors that you've got that sustainability and you've got the ability to actually see a project through and deliver returns is to actually get your hands dirty. So I would say if you're making $100,000 a year and you've got the tax returns to do it, I suspect that there'll be lenders that line up to lend you money, providing you're willing to put some in. I think it's very risky in your first property to not have skin in the game yourself. It's possible. I know Tyler's talked about ways that he's done it, but even and Tyler, you can correct me if I'm wrong, but even in your first deal, you still rolled your commissions into it, so you still had skin in the game in that first one that you did. So I would say the first thing I'd recommend is just have some money that you're willing to personally contribute into it. And if you are willing to contribute into it, I think you'll find guys that want to come along for the ride as financial partners very easily. But if you don't have any money that you want to put in yourself, it becomes very, very difficult to raise capital. You're on mute again. I must be leaving you
Man,
speechless here.
I swear I'm clicking the unmute button. Sorry, I keep doing that. Man, I need to get a little bit better about that. It never happens. Yeah, so I did roll my commission in on that first deal, and I signed on the loan. Right, like you've got to be willing to show your investors that you are going to put your money where your mouth is, because at the end of the day, if you're just trying to sponsor the deal and put no capital in, why would an investor really trust you? But Evan, what I would say is, I would go out and find a partner that's done it before, right? I mean, find somebody that has invested in industrial real estate before and partner with them. I mean, that's what I did when I first got my start in commercial real estate. I worked with a boutique development firm for 4.5 years before I went off and did my own thing. And because of that, I was able to learn everything from the ground up, which was really cool, right? Like I got to see office, retail, industrial, multifamily development, single family home development, everything in between. So that's what I would do is go find somebody in your market that's been there, done that, and see if you can kind of go put a project together with them. We've got another one coming in here from Philip. I actually met Philip out in Chattanooga when we were looking at our building a couple weeks ago. He says, I'm looking at warehouse space and the loans are all portfolio 5 or 10-year adjustable with a call option. If the interest rates rise dramatically over the next few years and cap rates stay the same, is it more likely that commercial property values will fall or rental rates rise? That's a great question. So we were actually talking about that a little bit on the podcast last night for the Commercial Real Estate Investor Weekly Update. Andy was talking about that because as inflation's about to start going up, interest rates will start going up. But what a lot of people are saying right now is that the economy is poised to grow so much that real estate will likely just go up in value, which is really interesting to see. Rental rates will continue to rise. So, if you're in a market like Nashville, you definitely know that and you can believe that. That's my take on it. I mean, Chad, what are your thoughts?
Yeah, this is literally a question that I ask pretty much every smart person that I know. So that's a great question that you're asking as well. So probably the best answer that I've gotten from this is from Peter Linneman, who's one of the top minds in commercial real estate. He was a professor at Wharton. He's been an advisor to a number of huge firms. So I asked him about that, and he said that he's expecting there to be asset value inflation as opposed to consumer inflation. That's kind of his forecast for this year, is that he thinks we'll just see inflation in properties, and that's kind of a function of there's just a lot of money in the system right now. When there's a lot of money chasing a few things, then we'll probably just see those prices go up. But the interesting thing is that it's really hard to determine what impact those interest rates will have on cap rates. The easy thing to say is that, yeah, I mean, if interest rates go up, we'll have to see cap rates go up correspondingly to make them look attractive, which will have a downward pressure on prices. That's an easy way to look at it, but that's also looking at that entire equation in a vacuum, and it never occurs in a neat, tidy vacuum like that, like a theoretical outlook that if interest rates rise, we see property values go down. It seems tempting to think of that, but there's just so many other moving parts. And Tyler, I think you make a really good point on that. Is if we do see prices go up, if we see rent goes up, then that could have that offsetting effect of cap rates going up as well, where the property values stay the same. I think it's purely speculative at this point. I have really no idea what to think of all of this. If we were to go back a year, well, let's say we go back 13 months to March of 2020, I was pretty pessimistic at that time. I thought the whole economy was going to unravel. I thought that this could be a long-lasting change. But what I failed to take into account was just the government's propensity to spend any amount of money that they had to keep the wheels from falling off. So I didn't account for that in kind of how I was trying to build out my model for this. But there's so many forces that we just can't keep into consideration all the time. But if we I think the REIT industry is a good one to look at this as well. So NAR REIT, which is the industry association for REITs, came into effect the same year that REITs were enacted into legislation in 1960. So REITs have actually been around for 60 some years now. Is my math right on that? 70 years. So REITs have been around for a long time. So you could appreciate over that duration, there's been a ton of ups and downs in interest rates as we went through crazy things. I was really young in the 80s, but I remember my parents having an interest rate on their mortgage for their house that was 18%. So the interest rates have been on a crazy roller coaster for that time. And cap rates have often had a sticker shock effect when we do see a big movement in an interest rate. Cap rates do tend to have a dramatic effect on it shortly thereafter, but it does also tend to stabilize. And even in the 15 years that I've been doing this, interest rates have been volatile as well. But I've found that cap rates, for the most part, operate within a very tight operating band. And I'm assuming this is pretty similar in your market too, Tyler. But I've seen that cap rates have been kind of in that 6% for like a really, really good quality property with a good tenant, perhaps a little bit lower for some outliers, but 6% for a really good tenant to 8.5% if there's some risk with the property. And again, you might find some a little bit higher than that, but that operating band of 6 to 8.5% has been pretty steady for the last 15 years that I've been in the business.
Yeah, that 6 to 8% number is typically a pretty good range. Nashville has started getting into the fours, which is just absolutely wild. Because I mean, if you look at like the country's distribution chain, I mean, within a day's drive, you can reach 80% of the world's population. You can reach 80% of America's population in a day's drive, right? So it's becoming fast becoming this distribution and logistics hub. Loving all these questions. Anatol's jumping in. Thanks for this. You're absolutely welcome, Anatol. Anytime, man. How difficult was it when you got started, and what did it take, or what did you do to get your first deal? I think that's a great question. I mean, tell us about your first deal.
Yeah, that is a fantastic question. So the answer that I always give to that is it sucked. Like it really did suck. I came from residential where I did reasonably well, and I had some money saved up because I had flipped a few houses with some friends, and I burned through all of that money. Like I was living on debt after the first year or so in the business because it's tough. Like I think commercial real estate is a lot harder of an industry to break into, but I also think that it's a lot better of an industry once you've gone through that pain period at the beginning. So it was tough. I never sugarcoat it for people. I think that there's nothing else that I would rather have spent the last 15 years of my career doing than industrial real estate. I am so glad that I took that decision to do it. But I also tell people that those first 3 years really sucked.
It really is. It's funny. Everybody says that too. It's always 3 years. The first year is the worst. It is the worst because you have no connections. I mean, I probably didn't make $1 for 6 months, which a lot of people can't do. I mean, I was working a job. I was still working as a waiter. I mean, it's tough. People underestimate that.
They really do. And the same thing, if I wouldn't have had some money saved aside from just being pretty fortunate on a couple investments, and I lived very lean. Like I was driving an old car. I think I was living with a friend in like a 2-bedroom apartment that was really cheap. Like I was living very frugally. And yeah, the first year was really tough. To the question though, on the first deal, it was actually a friend of mine. I ended up leasing him a small bay. He had a detailing shop, just detailing cars, and ended up doing, I think it was like a 2,000 square foot industrial bay, and we did a 3-year lease. I think my commission on that was 1,800 maybe gross. So I had to split that with my brokerage, and then I had to pay tax on it. I remember looking at that commission check at the after all the deductions on it, and I was like, holy smokes, this is going to be a lot harder of a challenge than I first thought. And it was tough. Like it was a grind every day, just trying to drum up business. I was young. When I got into industrial at the brokerage, I was 25. I really didn't have a ton of business connections. So it was tough. It was a tough slog. And I think even people that do have a lot of connections coming into it, I think even they underestimate how tough it is to just convince people that you are capable of doing a deal, and then entrusting you with a huge decision on their end. Like they're either entering into a lease that they're committing to for several years, or they could be spending hundreds or millions of dollars on investment. You've got to convince them that you're capable of doing it, and that just takes time. Whether you have 100 connections or zero connections, it's the same struggle of convincing people that you are capable of handling their needs.
Yeah, I mean, it's not easy. My first deal was basically relocating a tenant in a shopping center that we were already leasing. So, and I'd spent 6 months knocking on doors trying to find somebody else to do a deal with. That one just kind of ended up falling out of the sky. Tell us about your first investment. What was that like? I mean, how did you find it? How did you decide it was a good deal? I mean, what did that look like?
Yeah, so that was the end of 2014. I don't remember if we closed at the end of 14 or early 15. My memory is a bit hazy on when the timing actually was, but let's just say 2014. So I had actually been looking probably for a solid year before that. And with it being I had some familiarity with residential investing, but I really wanted to make sure that I didn't screw up that first one that I bought, because I figured that'd be the foundation of telling other people that I had a successful track record. Obviously, I wanted to maintain my own capital and maximize my return on that, so I was very careful. And on a side note for that, I typically give that same advice to people as well. If it's your first industrial property, be prepared to look at a dozen, maybe 20 properties as potentials before you find one that you're comfortable with. And that goes back to just even understanding industrial real estate at a deep level. You really have to have a firm understanding of what industrial real estate is and what demand is and what companies look for. And the only way to do that is to just be looking at a ton of properties. So I probably spent the majority of 2014 going through like mini underwriting exercises of looking at a property that was for sale, building out a pro forma on what I thought revenue could be, how I could potentially get any increases in rents, what my expenses would be, even projecting out like a 5 or a 10 year NOI, and then figuring out what I thought a cap rate would be. Like I would go through a full process of figuring out what those were. And as luck would have it, one of my clients had a small bay, so we still own this bay to this day. It was a 2,500 square foot bay, and he wanted us to sell or lease it. And we ended up finding a tenant for it. We did a 5 year lease with a company that sold kitchen equipment. And he agreed to do the lease. And then we asked him at that point, would you consider selling it? And he said, I still want to sell it. So we made him an offer for it. And by that point, I had gotten to know that building quite well because I'd showed it a handful of times. We did the negotiations on the lease, and he agreed to sell it to us. So that was end of 2014, and still have that property. We're onto our second tenant right now in there. That the kitchen company moved out. Now we have a machine shop in there, and we just extended them for another 2 years. So it's been a great little bay for us, and that's the first one you're pretty fond of, and this one's no different. I really like this little property. We've since added a lot bigger properties to the portfolio, but I still have a special place in my heart for that little guy.
Yeah, because that first one is what got it all started, right? I mean, I'm actually under
Yep.
contract in like literally 8 days. I'm closing. I'm selling the first property I ever bought, and it's kind of bittersweet, man. I mean, it's like, it's not the best investment in our portfolio by far because it was the first one I did, and I'm not nearly as good as I am now when I bought it. But it was a great first project. We made a pretty good return on it. And now it's time to give it to somebody else so that they can do the same thing. What you were saying actually kind of leads into Evan's follow up question. He says he does have about $200,000 saved up to put towards a building. What size would be good to start at? I mean, I would imagine obviously it's going to depend on if he wants to bring investors on or not. But you started off with a 2,500 square foot industrial condo. Is that something you would recommend?
Yeah, as long as the numbers make sense, I wouldn't be as focused on the size as much as just optimizing your investment. So I don't think you necessarily need deploy all 200,000 of that to get the right investment. You might be able to deploy half of that and save the other 100,000 for the next project. I think starting small would be the best thing that I could recommend, because you'll learn so many things during that process, and your risk will be mitigated. So the first one that we bought was roughly 400 grand, and if memory serves, we put about 60 grand down, and we had to separate some utilities in the space, and we had to add a new HVAC unit. So I think we put another 30 into it as part of our deal with the seller. So we were roughly 90 grand into it. And with having a $310,000 mortgage and the rent that we were collecting, it was cash flowing. So we were cash flowing from day one. We were paying down principal on our mortgage. And that was just a really good investment. We learned a lot about just the process of how you need to set up your accounting, how you're setting up a corporation, if you're doing it by yourself or if you're doing a GPLP, which we've done that now as well. I think starting small would be more advisable than necessarily having to deploy all 200,000 of that. That 200,000 will make you very financeable from a lending standpoint, especially if you're not going to use it all. But I think if you were to look for an industrial condominium or a small industrial property, and you're in that 500,000 to call it 750,000, and I think that'd be a fantastic investment for you to really get a sense of what industrial real estate can do as an awesome asset class, but also ensuring that you don't have substantial risk in that first property. So the main thing I would say though is just make sure that you're getting a property that when you do your pro forma and you figure out what your financing package is going to look like, you know that you're going to be cash flowing day one. I think cash flow is imperative as an owner. Make sure you're cash flowing, and then start doing some projections on what does it look like 5 years down the road after you hold it for 5 years and you're paying down your principal and you're taking advantage of some tax deductions, and perhaps you have some rental escalations in there, or you think you can do some value add and increase the rents at some point. Build yourself out a 5 or 10 year model on how you think that could look, and as long as the numbers are checking out, and we can go deeper as well, Tyler, into IRR and NPV, but from like a very basic standpoint, there's just what's your cash on cash return, and as long as that's checking out over however long you're projecting to hold that property for, I would say get the right property as opposed to focusing too much on the size.
Yeah, I would agree with that. I think that well, first off, getting to what Chad was saying about underwriting, every Wednesday at 5:30 p.m. Central Standard, we're going live and underwriting tomorrow we're doing a medical office building. Last week we did a single tenant net property. If you want to learn how to underwrite these deals and how to determine those returns, we're doing those live. Feel free to come join us. But I think Chad's totally right when he's talking about don't put the whole 200 grand into one property. I mean, the great thing about real estate is that you can use leverage, you can partner with other people, you can use their capital, you can diversify, right? What if you put 50 grand into 4 properties? If one of those properties goes belly up, you still have 3 more to carry everything, as opposed to the one property that you've got 200 grand in. Look, investing in real estate's risky, right? There's no investment that doesn't have some form of inherent risk. Let's see here. Vic is jumping in with a question. What would you do starting out with 1.5 million saved? I would imagine, Chad, you'd probably say pretty much the same thing, just scaled up to 1.5 million, right?
Yeah, and even before we get to that answer, I want to add one thing on there too, Tyler, because you touched on a really good point earlier about the value of partners, and I want to echo that because I think having a partner does a few things. One is it helps you diversify the amount of money that you can spread out into different properties, but it also helps check your blind spots. And quite often as investors in real estate, you can become so emotionally attached to a property, or you can be attached to a tenant, that you run the risk of losing that objectivity. So my partner that I own all my commercial real estate with, my business partner as well, he's also a commercial real estate broker. we do a really good job of bouncing ideas off each other on things that work or things that don't work or areas that we have to be concerned. And I would lose that wisdom that he has and that different lens that he sees things through than I do, and that's invaluable to me. As much as his capital has helped us grow our portfolio together, I rely on him heavily for the insight, and vice versa. There's areas that I have strengths in that we look at things differently. So I to the last question there on how you would spend that 200 grand, I think if you were to take 50 grand and try and go and get a couple people that are in the business already, if you could find an appraiser, you could find a mortgage broker, a lawyer, an accountant, or anyone that has some knowledge on business, and you could say to them, I've got 50 grand, why don't we get a couple guys together, and we'll run this as a partnership. I think you're going to have a much better chance of long-term success than just trying to go out and do it by yourself. And I know
That's
you're a big believer in this too, Tyler.
I was gonna say that's great advice. I mean, that's absolutely fire. It's so true, man. You can go out and get other people who have complementary skill sets that know things that you don't, right? Like smallest amount of members that I have in any given deal is three. I don't own anything by my own because it doesn't make any sense to me, honestly. Like again, it's leverage is one of the most beautiful aspects of commercial real estate, and having partners is a form of leverage, right? Because if I've got three people signing on the note, then that's three people who are jointly sharing in the risk of that debt instead of it falling all 100% on me. That's
Mhm.
three people who can split the down payment. That's, I mean, it just, there's three people who are going to be out talking and may run across a tenant that's perfect for the building. It exponentially increases your chances for success. So I think that's great advice, Chad.
Yeah, and so to get to the next question of the guy that has 1.5 million, I mean, you're already had some significant financial success. So I think the biggest thing that I would do, and I'm not a financial advisor, so I don't want to be given financial advice on it, but the biggest thing that I'd recommend if you already have 1.5 million would be to make sure that you always protect your downside risk, because you have 1.5 million, you're already well on your way to a comfortable retirement. If you just put that into an industrial real estate investment trust, you could make a 4% yield on that, and you could make a comfortable return just on a pretty consistent yield from a REIT. So I would say the biggest thing I'd recommend if I were in your shoes is to just make sure you protect that 1.5 million. So don't lose money. Kind of be like the Warren Buffett
Yeah.
analogies. Don't lose money. So I would say with that money that you have, just be very prudent that everything you're spending on has a very low probability of that downside risk. And with industrial real estate, it's unfortunate that inexperienced or investors that rush into it can experience significant downside risk because they just don't understand the asset that they're buying. So I would say to you don't need to take the same risks as somebody that only has $25,000 to invest, because the person that has 25,000 is trying to build wealth to get to the level that you're already at. So I would say to you is to not take big risks that a smaller investor might, but instead to just be very focused on earning consistent returns and trying to eliminate or at least significantly reduce that downside risk.
Yep, I think that's great advice. Yeah, I mean that's true. If you've got $1.5 million in cash, I mean you're already on the way. Now, if you're making $1.5 million a year, then that your risk profile should probably be a little bit different. But yeah, I mean take a third of that or take half of that and invest it. I wouldn't look at doing it all. Now, if 1.5 million is what you have set aside specifically for real estate, I would go out and just diversify that over a handful of deals, right? I mean,
Mhm.
put $100,000 into 15 deals. Go find deal sponsors, general partners that are syndicating commercial real estate, and throw it in with them, because or take $250,000 and do it. And you could also diversify through funds. You could diversify through a REIT. You could go get your own property. You could invest in a syndication. I mean, there's 4 different ways you can invest in real estate right there. Let's see. Vic also has a follow-up question. Would you invest out of state or near your base location on your first deal if you know what you're doing? So he knows what he's doing. I think And my opinion may be completely different from Chad's. I think you invest where you're going to drive by every damn day, because especially for your first one, you're going to constantly be thinking about it. Typically, there's some work that needs to be done. Um, I didn't invest out of my area until this year, and I've been in real estate for 7.5 years. I've found that there's plenty of opportunities that I'm very, very comfortable with in my neighborhood, and in the neighborhoods that I like to invest in. So to me, of course, now, like if we're talking about absolute net leases, it doesn't matter. You can buy that in New York, you can buy it in California, you can buy it in Florida. It's going to be, you can buy it in Canada. It's going to be the same thing. It doesn't matter. But Chad, what's your thought on that?
I couldn't agree with you more, Tyler. And I would add to it as well, that I think investing in your home market is just the smartest thing that you can do with your capital. Unless you're a massive corporation that has the resources to put a local team on the ground and you've got access to considerable market information, I think one of the biggest advantages of investing in your hometown is that you just know that market really well. You're intimately familiar with it. You're probably following all the trends, reading the reports on what's happening with vacancy rates and absorption and what tenants are moving. You just have a much deeper knowledge of the market than you would if you were to. So let's say you're in Nashville. If you were to go and buy a property in Chicago, Tyler, you're not going to know Chicago as well as Nashville. It's just impossible. And if you wanted to know the market in Chicago that well, then you're going to have to dilute the amount of energy you can put into knowing Nashville. So I think having that deep knowledge of your local market is a powerful, powerful tool. And the other reason that I'm a big proponent of investing in your market is that if you do have a vacancy come available, or an opportunity comes up, maybe somebody wants to buy it off of you, and you've got an opportunity to sell it. I think if you have the ability to know that property really well and drive by it every day, like you said, and just know exactly what's going on in that property, I think you're just going to have that much more attention given to it, and you're also going to have the ability to pivot much faster. So this has happened with us. That one small bay that I mentioned to you, when that kitchen equipment company left, we backfilled it very quickly. We might have had a month downtime where we just did a quick renovation for the guy, and we did that because we know the market really well and we're familiar with it. If I had that same investment in another city, I don't think it's reasonable to expect that I would have been able to fill it as quickly, just because I don't know it as well. So I think that there's a big power in investing in your market, so much so that I would expect there to be a considerable risk premium attached to any property that I considered outside of the market, outside of my market. All things being equal, I'm going to invest 100 times out of 100 in my own market before I look somewhere else.
Yep, same here. So appreciate the questions, guys. These are great. Keep them coming in. So Chad, Amazon has had a massive impact on the world of industrial real estate. Tell us about how that's looked over the last 5 to 10 years, and what you think it's going to look like over the next 5 to 10.
Yeah, so I maybe we can even talk like even broader than just Amazon. So I think Amazon's a good symbol of this e-commerce movement on things moving away from that bricks and mortar to more of a order online and have delivered. Amazon's kind of like the symbol for that whole thing. But I think we can talk much more broadly, because every company has had to increase their logistics infrastructure, kind of the supply chain, if you will. Products made somewhere, it's distributed, it's transported, it's stored in a warehouse, and then it's sent out. Every company has had to adapt to that. So e-commerce has grown probably for the last 20 years. It's hit critical mass over the last year as a number of stores were forced to close. People still want to buy stuff. I don't know about you, Tyler, but my family has still bought the same amount of stuff over the last year as they did the year before. We just
Yep.
didn't do it in a store. It was ordered online and we had it delivered. So we still like stuff. So there's been a big movement towards this e-commerce construction, and that goes back to differentiating industrial real estate into those subcategories. The manufacturing side, a manufacturing building is quite a bit different than a warehousing building or distribution center. These warehousing buildings are designed for one simple task. Things come into it, those things are stored or repackaged or or boxed up into smaller packages, and then they're shipped out. They might stay in the warehouse for a year, they might stay in the warehouse for an hour. But the whole purpose of these facilities is that things come in and things go out. So it's fascinating seeing the massive increase in these facilities going up. That's what's actually driving industrial real estate in almost every market in the world right now. And that's probably sound a bit repetitive on it, but that's why I think it's so important to break industrial real estate into those subcategories. I'm in a market that's got a heavy oil and gas play, and with oil being down considerably over the last 6 years, our manufacturing side of industrial real estate's been under considerable pressure. But the logistics, the warehousing side has been going through a boom. And I suspect that that's similar in markets all over the world. I know in North America, I study this pretty extensively in the major markets. If you look at like a market like Vancouver right now, Vancouver, it's got the ocean on one side, it's got mountains on the other, it's landlocked everywhere. Their vacancy rate for industrial real estate right now is less than 1%, which is mind blowing that there's a market right now with less than 1% vacancy. And LA is 3%, New York is under 2%. Like some of these major port cities where things are just coming in at a crazy pace, they're experiencing record low vacancy rates. And that's all driven by this e-commerce infrastructure that's had to get built up. So a term that a lot of people are probably more familiar with now is that last mile delivery. And last mile delivery is a logistical term, basically meant to imply it's not a literal mile. It could be 5 miles, it could be a block, but it's the step in the supply chain where it goes from a warehouse or a store to the customer's door. That's what they consider last mile delivery. And there's been a race with all these big logistical companies to increase their infrastructure so that they can more efficiently and more profitably get that product for the last mile. So last mile has been probably one of the biggest drivers of warehousing space and industrial real estate in general. But it also you can't neglect the entire supply chain and the importance of the entire supply chain. So whether it's something coming from China and it's landing in a port on the western side or on the eastern side, then it makes its way by truck or train. In every one of those steps along the way, there's going to be a warehouse or some building that's facilitating these products. So there's been a crazy growth in these areas to accommodate things transitioning from retail to all of us ordering stuff online and having it show up at your house same day. Sometimes in 2 hours, you can get stuff now.
It's unreal to see. We were reading some of the statistics about how much has just gone on in the last year. I mean, it was like every hour there were 555 orders through Grubhub for food delivery. And every hour, 555 orders. I mean, we're just moving to this online order delivery based society, which is really interesting, which means industrial real estate is going to have high demand. I mean, that's last mile delivery right there. Think about that, how much demand there's going to be for that type of space. So, Chad, speaking of online, you got your presence in commercial real estate really growing with your online presence, with your online actions, right? I mean, you were blogging back before a lot of people. You inspired me to blog, and because of that, now we've got one of the top blogs in commercial real estate. Talk to us about that and how that. One, why did you do it, and how did that impact your business?
Yeah, I'm sure it's similar to your story where it has to be a labor of love for one thing. I think anybody can do something for a small period of time. Like if someone hated writing, but their boss said to them, you have to go and write a blog, they could probably do it for a little bit, but they're not going to thoroughly enjoy it. I just really enjoyed writing. I don't know if that was just kind of a weird quirk that I have, or a creative outlet that I needed to express, but I just really enjoyed writing. So I started blogging over 5 years ago, and I wrote a blog every single week. I didn't miss a single week for 5 years, which is crazy to think about. That's
That's
over
so long.
250. So long, over 250 posts that I wrote about on commercial real estate, and we grew a following on it. We had people that commented on it all the time, and it helped our website just from an SEO standpoint because we had so much content out there when very little was being done to compete with us. So first, I really enjoyed it. I think that that's the key for doing things is if you're going to try to do something, you have to have that long game in mind. That doesn't happen easy. It doesn't happen quick. But if you like doing it and you can see yourself putting in that effort, you can see some results over time. Funny enough, I actually just paused doing the blog. So after 5 years, every single week, I decided to take a break on it. And part of it was I want to explore YouTube more. I really want to see if I can put more compelling videos out there, and I just only have so much time in the day. So it's just kind of made the decision that 5 years it was time to take a break, and still love that creativity side to it. So that's what's kind of pushing me over to try YouTube now.
Man, I don't blame you one bit. We've been writing a blog post every week. When the pandemic hit, I actually started off writing like 3 to 5 a week because I
Wow.
had nothing else going on. So just built it up. And now, I mean, we rank on the first page for like, I think if you type in commercial real estate investing, we're on the first page, which is crazy. But I'm right there with you. This week I haven't written one, and I'm like, man, it was supposed to go out today. I don't know. I'm clearly not going to get around to it now. When am I going to write that and catch up? Because it's a great way to teach people, what's going on in the world of real estate, right? Because there's not a whole lot of resources out there. So, for those that are watching, what kind of like where are you getting your data from? Like what news sources do you read? Who do you talk to learn more about industrial real estate so you make these educated decisions?
Yeah, great question. So I'm a member of SIOR and CCIM, and they both put out regular publications. So they put out a print magazine, but they also put out a lot of content on their website. So there's either like a web article you could read or a quick podcast. CCIM has a good podcast now, so I'm pretty up to speed on all those. Another industry organization that I've been a member at for years is NAOP. It used to be an acronym. It used to stand for the National Association of Industrial and Office Properties, and they've since abandoned that acronym, and now they're just called the Commercial Real Estate Development Organization, something like that, anyways. But their whole focus is on industrial real estate, or at least that's a major component of their focus. So they also have a magazine that goes out, and they put on a ton of seminars. I probably sit on through a webinar one a month right now, and they've put out some great ones on industrial real estate. Membership isn't crazy expensive, and that's an organization where I get way more value than what it costs. So those would be the three main ones. There's seldom a week that goes by where I'm not sitting on a webinar on one of the three of them. And then I try to read a lot. I probably read way more than I should, but I read a lot of competitor reports. I listen to competitor podcasts. CB has a great podcast, probably the
They
best
do
one.
the weekly take.
Yeah,
Yeah, it's
yeah,
good.
it's really good. So I've directed people to that one as well because if you just want to sit through a quick 45 minute or 60 minute podcast and listen to what they're saying, that's a fantastic one. I read a ton of brokerage reports, and then I probably the website that I rely on a lot is Globe Street. It's just globest.com. They break down their news into to different categories, and they cover industrial as one of them, and they put out a lot of really good information. So if I check on that one regularly, I probably check Globe Street a couple times a week just to see what they're putting out. But I really do make a conscious effort to stay on top of as much of this stuff as I can. Even on on a full nerd level, I even have subscriptions to a couple supply chain magazines. So it's not necessarily directly tied to warehousing, but they do talk about a lot of stuff that directly ties to it. So I think you got to find sources that you can go back to often. Some cost money, some are free, but it's just a consistency thing of trying to stay on top of that as much as possible, as opposed to trying to drink from a water fountain get all that information in one sitting and try to remember it. I think it's much more effective to just consistently do it and let that stuff sink in over time.
Those are some great tips. I think the CBRE's Weekly Take is such a well produced podcast.
It is.
Um, you know, I'm constantly reading the local news, right? Because there's so much that's getting announced. The Business Journal is actually a great, if you're in the United States. I don't know if Business Journal is in Canada or not, but Business Journal is great. But for me, it's all podcasts. America's Commercial Real Estate Show with Michael Bull. It's a pretty good one if you want to get further into kind of the higher level, like real estate investment trusts, hedge fund type of stuff, which is pretty interesting to see what they're doing. He also interviews the CoStar guys all the time, because they've got some data. ICE is asking, how could you practice case studies to master the numbers for a new CRE agent? That's a great question. I mean, what I would do is put yourself in the investor's shoes, because the most frustrating thing as an investor dealing with an agent is an agent who has no idea what they're talking about when it comes to investments, right? Because I used to get bogged down all the time with new agents that would send me deals like, you need to buy this. This is great. And I would look at it and go, this isn't even remotely close to a deal. How did you think this was a deal? So if you go through and just practice your underwriting and get really good and understand how an investor is going to look at it, then you can really pitch to your investors. When I went through CCIM, and I'm getting my designation hopefully this year, but I learned how to underwrite through CCIM. They gave me all the spreadsheets, and that I took, I think it was 104, which is really the underwriting class. And 3 months later, I sold a $1.8 million AT&T because I went out, found it, fully underwrote it, sent it to a client, and he was like, yes, I will do that. So that, to me, I was like, wow, that class paid for itself like 10 times over. I think that's the best thing, is to like just make a goal to underwrite a deal a day. Just go find anything. It doesn't even have to be what you think is a deal, but you'll very quickly learn what could and could not be a deal. Chad, what are your thoughts?
Yeah, that's a really good point, and congratulations on getting close to your designation there. It's
Yeah, thank you.
I've had it for a number of years, and it's a great designation. So I congrats on getting close to that. I agree with a lot of your points. I think one thing I would add to that is an underrated skill at the beginning of your career is establishing relationships with professionals, and it comes organically over time. Like you'll meet lawyers, you'll meet bankers, you'll meet appraisers, but if you make a focused effort at the beginning of your career to try and forge some relationships with those guys, I think that that's a huge thing that you can do, because they can fill in a lot of the gaps in your knowledge that you just don't know. You might not know what closing costs are, on what a lawyer's fees are going to be on a transaction, or what design fees are going to be if they're redesigning a building. There's just so many holes in the knowledge that you just don't have at the beginning. So if you can meet a banker, an architect, a designer, a lawyer, and strengthen those relationships early on, run ideas by them, because they'll tell you what numbers you need to put in as inputs on there, and having them look at it like a mortgage broker is a perfect example, because a mortgage broker will help you through that process, and you can make it a value add proposition for them by saying, if you ever need some data, if you ever just want to have a comp on what happened on a building next door, I'm your guy. Like I want to be your resource for any market intelligence that you need. Even if I don't know it, if you ask me what's happening on a property, I'll track it down and I'll get you that comp. I think that's a very powerful thing that you could offer to that banker, and again, that goes for anyone, a lawyer, an accountant. If they need to have some data, if you're their guy and they know they can count on them, they'll return that favor and help you out along the way as well. So I would say just try and establish those relationships as early as you can, and use them as a sounding board. Like if you got to know an accountant well, and you would help them out with something, or they knew that they could count on you for help, and you just said, hey, I got this quick pro forma I want to run by you just to make sure my numbers are okay, would you mind taking a quick look? I suspect that they would say yes, and if they said no, I'd find another accountant to talk to, because the one of the most powerful things that I've done in my career is establishing a lot of those relationships, and I've got guys that I can contact and get that information if I need it, and the corollary to that is they can do likewise with me. So that'd be the biggest recommendation that I'd make when you're going through that underwriting process is don't try and do it in isolation, just all by yourself until you're comfortable with it. But like Tyler said, the more you do and just the more comfortable you get with it over time, the easier it is. But at that beginning stage, don't underestimate the value of just having people help you along in that process.
There's something to be said too for being a beginner and being able to ask those questions, right? Like there's nothing wrong with it. Everybody's is willing to help you and talk through that, right? Because you're
Mhm.
new to it, and those attorneys, those bankers, whoever the CPAs, like they want to build a relationship with you because eventually you'll be bringing them business too, hopefully,
Mhm.
right? The better you understand it, the better off everybody's going to be. I mean, I can't sit down and ask those questions usually, right? Like it'd be weird if you sat down with me and 7.5 years into the business, and I was like, "What's a cap rate?" I mean, I can't really ask those questions, but like, there's a beauty in being new into the business. You can ask any question, and people are just like, "Oh, well, yeah, this is exactly what it is." So feel free to meet with those people and ask all those questions because there are no dumb questions. I mean, seriously, you got to learn it somehow. I love this. Philip is asking probably a very interesting question. Can you walk me through how some four cap deals make sense for buyers? After leverage, I think that's a very low rate of return with no cash flow while taking on a lot of risk. I regularly ask listing agents to explain to me how four caps make sense. No good answers except people are paying it. Philip, it's funny because like I'm laughing because it's painfully true how often you come across that. Like I'll yell at my team sometimes like, "How the hell are they justifying this deal? How does this make any sense?" So like, so I've got two analysts on the team, and all they do is underwrite full time. And I'm like, y'all need to figure out how to make this make sense because somebody's making this make sense, and we need to figure out why. The real answer is sometimes some people just have so much money that they have to deploy, and getting a four cap is better than having it sit in a bank account. There are other ways, maybe the cash flow is not all that great, but they see a high upside in the appreciation. They're just parking the money for 10 years. Also, we'll be talking about this in the live stream. Well, it's not going to be live tomorrow because I'm going to be in Chattanooga, but in the underwriting video tomorrow night, we will be talking about cost segregation studies. That is one of the ways that they can actually boost those returns to make it make sense, right? Because a cost segregation study increases, it's basically accelerated depreciation. And so you can write off more on your taxes, shelter more income, and you actually end up making a little bit more. The other thing, and the only way that I could see anybody justifying it, is through a 1031 exchange, right? Like you've got a massive amount of money. You don't want to take a penalty on paying taxes to the government through capital gains. And so you're going to 1031 exchange into another property. And four cap is better than nothing at all. It's definitely better than paying 20% plus in capital gains. Um, and it's probably a better cash flow, even though it's a four cap, it's probably better cash flow than the last property you sold to 1031 exchange. Just because you had parked money there for so long, you snowballed it. Now you're 1031ing it into another property. I mean, Chad, what are your thoughts on four caps?
Yeah, I think it's a great question, and I guess my answer to that would be it's purely speculative. I think the buyers that are willing to pay those cap rates are speculating that the market is just going to appreciate at a faster rate than their short-term cash flow considerations. And I think if we were to look at the stock market as an example, we could look at Tesla stock. Tesla stock makes absolutely no sense at its valuation. Like it's
Even
traded
Elon
at a
says that.
multiple. Even Elon says it. The owner, president of the company says that, but it's trading at such an astronomical PE that it doesn't make any sense from a rational, logical investor standpoint. But the people that are willing to buy stock at that level aren't buying it for today's value. They're buying it for what they think it's going to be worth in 2 or 3 years. And I don't know where the guy who asked the question is from, but I'm guessing if he had the opportunity to buy a property 10 years ago at a four cap, I'm assuming that would have actually been a pretty smart decision
Yeah, he's
in
he's in
retrospect.
Chattanooga, so that's probably very true.
Yeah, so but that comes with a considerable amount of risk. I'm not a 4 cap buyer myself. I would not be buying a property at 4 cap because I think there's so much
Absolutely not.
risk that comes with that. And to his point, like if you put leverage on there, then you're negative cash flowing. Like there's just no, the math does not work that you're actually going to come out ahead on that. And I'm not a negative cash flow buyer. But there, to your point as well, is there's some buyers that can buy with cash, whether they're doing a 1031, whether they just have a bunch of money sitting on the side. If they think the market's going to be worth more in 5 years than it is right now, they're not even making a logical decision based on cash flow or a cap rate. They're just purely speculating that the market's going to go up. I'm not one of those investors myself, but I can understand why people do it.
That's what investors in LA do. I mean, they buy on 3, 4 caps. I mean, it's incredibly low, but they know that they're going to lose money for a few years, and then they'll sell it to the next guy. And that's just, to me, gosh, investing in real estate like that is, I can't imagine it. I mean, I guess maybe if you're in LA it works, but gosh, I can't see that ever working in Nashville. I would never do it. Well, Chad, this has been a great conversation about industrial real estate. If the audience wants to get in touch with you, or if they want to check out anything, your blog, your YouTube channel, where do they go?
Yeah, YouTube channel would be great. Or if someone wants to send me an email, it's Griffiths, GRIFFITHSCRE @gmail.com. I try to respond to every email that I can, and I've even had video calls with a few dozen people over the last several months as well. So if someone has a question, they want to reach out, I try to be as generous with my time as I can, because I had a few people when I first started in this business that took the extra time to explain it to me. So I'd really like to be that resource for whoever wants to listen to me drone on about industrial real estate.
That's awesome, man. Well, Chad, thanks for being here. If you are watching live on YouTube, don't forget to like and subscribe, and join us Tuesdays at 5:30 p.m. Central Standard Time. We're coming at you with these interviews, or sometimes Andy and I are just kind of jumping on and talking about anything commercial real estate. If you're on the podcast, don't forget to rate and review so that we can keep bringing this awesome commercial real estate content to you guys, and we will see you next week.
Thanks, Tyler.